1. You have zero doubts about your abilities. It might sound counterintuitive, but the biggest trigger of alarm bells for investors might be when they have a lot of confidence. Complete ignorance can lead you into a lot of trouble in the stock market, but so can knowing just enough to be dangerous. In other words, you do have a good grasp of investment fundamentals, but you're overconfident in your own skills and dismissive of the role that luck and randomness may play in your investment experience. This can lead to speculative bets in the market, taking on more risk than you can truly afford, or missing opportunities because you didn't even realize they were there. People who tend to do well in their financial decision-making are those with a healthy relationship with self-doubt. That doesn't mean they don't believe in themselves or feel uncertain that they find themselves paralyzed, unable to act. It means they acknowledge the limits of their own knowledge and understand the realms in which they're a qualified expert and know where they're not. They eagerly seek out people with more knowledge in particular subjects and enjoy the process of learning. They ask a lot of questions rather than assuming they already have the answers. If you're unwilling to question your own assumptions, or you resist reaching out to people with more qualifications or experience to get second opinions, that's a red flag. Investing is complex, and the more education and mentorship in the field that you can get, the better off you'll likely be. Seek to be a perpetual learner and learn to love questions. Good investors know real confidence comes from feeling secure about where you stand, while at the same time being comfortable with the reality that you can't know everything. Therefore, they're willing to question their own beliefs and challenge what they think they know to improve and expand their knowledge. 2. You lack a rules-based system. One of the biggest mistakes I consistently see people make when they invest on their own: trying to time the market. People want to wait to invest until after a certain event, like an election, is in the rear-view mirror. They think it's a sure thing that the market will do this or that, but the truth is, no one knows with certainty how the market will move at any given point in time. If you held off putting money in the market in November 2020 because you felt confident the market would react negatively to the outcome of the presidential election, for example, you would have missed a major market rally that month. Others want to pull their money out of the market on a prediction about what might happen in the future. Many people moved their portfolios to cash in the spring of 2020 as the virus pandemic took off, predicting catastrophic failure. At first, they might have thought they played it smart as March 2020 saw the fastest developing bear market in history. These folks didn't look quite so wise, however, when immediately after we also saw the fastest recovery in history, with markets hitting new highs by the end of that same summer. Some people managed to get market timing right. You'll find no shortage of anecdotal evidence showing that so-and-so predicted this market event, or that fund managers successfully avoided that market catastrophe. But these stories are more about luck and chance than knowing something that everyone else failed to understand. There is no reliable, evidence-backed way to time the market and get it right over and over again. You can get lucky once, maybe even a few times. You will not, however, get lucky every single time, and just one misstep can leave you with a much bigger loss than you otherwise would have by simply following a consistent investment program designed to provide a reasonable risk-adjusted return over the long term. If you want to be a successful investor, then you need a systematic method that you stick to over time. This system should be rules-based with no room for emotional decision-making. The strategy should align with your specific needs and goals, not someone else's. If you're just investing based off of your emotions, gut feelings, hunches, speculation, or hearsay, you're setting yourself up for failure in the long run. Good investors understand the power of a plan and can hold steady even when the market or life feels shaky. 3. You don't distinguish between realized and unrealized gains or losses. 2020 was quite the year, to put it mildly. We experienced massive ups and downs everywhere. In our workplaces, in the news cycles, in our personal lives, and certainly in the markets. When the market dropped over 30% in the spring, people panicked about losing money in their investment portfolios. But the thing is, unless those people sold out of their positions, the losses they saw were unrealized. While their investments might have lost value, they did not necessarily lose money. The only way to lose money would be to sell for less than they bought. If you stayed put in your portfolio, however, you would have likely seen that value climb again over the summer and fall. This might seem like a nitpicky distinction, but it matters if the thought of losing money drives you to make emotional decisions or just poor choices with your investment portfolio. The same could be said for the other side of the coin. If you see gains in your portfolio as making money, you might be tempted to deviate from a set investment strategy for something that will earn you more. But just like unrealized losses, unrealized gains aren't actually money in the bank until you sell and lock in any gains. Good investors understand that any unrealized gain or loss, day to day, doesn't matter in the grand scheme of things. It's more about the assets you're trying to build for the long term, which might be 20, 30, or even more years into the future. They don't obsess over the money they lost, and they don't gloat about money made. They stay focused on the end goal, which is growing a portfolio over time to reach a particular goal, like cultivating assets that will generate income for life or growing wealth that can be passed to heirs or shared with causes they care about. 4. You don't know how taxes affect your returns. The U.S. government doesn't let you have the money you may make investing for free. When you cash in, you'll owe what's called capital gains taxes. Some withdrawals, like those from retirement accounts in some cases, can be taxed as income. Various factors affect how much you'll have to pay, such as how long you've owned the asset. You'll pay a higher capital gains tax rate on investments you've owned for a shorter amount of time. There's another reason to invest for the long term. Taxes can greatly impact your investments. If you're working and have many years until you need to access your money, your taxes and strategy are a lot different than when you are retired and pay taxes as you withdraw money from the returns generated within a workplace retirement plan, such as a 403(b) or 401(k). 5. You fall for the stocks that everyone likes. Beware of the stocks that everyone likes, even though they may be the stocks of outstanding companies. Even if the growth comes in on schedule, the stocks may not go up. They're already up. Should earnings not continue to grow as expected, such stocks can collapse, even though the underlying company may remain sound. On the flip side, don't buy a stock just because everybody hates it. As Buffett notes, a contrarian approach is just as foolish as a follow-the-crowd strategy. What's required is thinking rather than polling.